morning, everyone, and welcome to the Wealth Builders Masterclasses. I'm Vinky Loomba, founder and CEO of Loomba Investment Group and the host of Wealth Vibe Show. So today we're going to be talking about the multifamily. Multifamily investing is entering a new chapter. We all know that. The period of inexpensive debt, strong rent growth, and easy refinancing has changed quite a bit. Today's success depends far more on disciplined underwriting, responsible leverage, and strong operations. And also going in basis has to be really strong. The opportunity in multifamily, it hasn't disappeared. Don't get me wrong, but I think the players are changed and the playbook has been changed. So today we'll explore the new rules of the multifamily investing and how the experienced operators are adapting into this market. Before we get started, I have a small little disclaimer, so I'm going to share my screen quickly. So this session is strictly for knowledge sharing purposes and should not be considered as a legal, accounting, or investment advice. This session does not represent an offer to sell or a solicitation of an offer to purchase an investment or security. So if you have any questions regarding the investments or any legal questions, please reach out to your CPAs or your attorneys. This session is strictly for educational purposes. And we have some housekeeping items. If you have any questions, please use the Q&A box. And the chat is open. You can use the chat as well, but I would prefer if you can put your question in the Q&A because chat sometimes gets chatty and then you miss the question. And in any case, if you miss any question, please email it to me at pinky@loombainvest.com and I promise I'll get back to you. And throughout the session, it's a kind of a Q&A session. I don't think George has a presentation. So you can ask us any question at any time. So, like I told you, my guest is wonderful George today, George Abreu. He's the founder and CEO of Alleyward Commercial Investment Group and GNT Construction. George brings a vertical integrated perspective across acquisitions, construction, renovations, asset management, and property operations, giving him insight into how a deal is underwritten and how that business plan performs after closing. So, George, welcome to the Wealth Builders Masterclass. I'm super excited. You wear so many hats, so can't wait to hear.
Thank you, Vinky. I'm excited to be on and sharing my experience. Where would you
Great.
like me to start?
I would really like to begin with an actual experience rather than a market prediction because we hear that so much from so many different people. There's so much information out there. So what I would like to learn from you is I wanted to ask you if you can take us inside a deal or an operating challenge when you recognize that multifamily strategies that worked in the past are no longer sufficient or working.
So I want to say it was maybe about a year and a half ago or so, maybe even 2 years ago. Started getting a little harder to bump the rents, with all the supply that had come online, and it was hard to get those rent bumps. So, at that time we had to make some adjustments, and had to make them quick. So we really started focusing a lot more on items that specifically get us a return on investment. So with our capex and the money being put into the property, and what I mean by that is, things like, let's say if carports, if we're able to rent the carports and we can build some more, we went ahead and built them. Backyards, we were still able to get, maybe we weren't able to bump the rents, but we were able to get premiums for the backyards. So we started focusing on building more of the backyards and little things like that, where we weren't just spending money to fix items that possibly can increase the value of the property, but more direct return on investment where we can really measure it. So I know that was one thing we really focused on, and then started focusing a lot on operations. We brought in property management about 3 years ago. We started our own management company, and then really been focused on how do we bring these expenses down, right? Every dollar saved on expenses is the same as adding a dollar to rents, right? So We got really, really good at controlling the expenses and increasing the NOI that way as well. Um, so I think that's maybe one of the biggest changes when you look at new deals or you try to, several years ago, it was you could do these massive rent bumps, right? We had our rent growth was ridiculous in certain markets, and that's just not the case anymore. Do I think? And I know you don't want to talk about predictions too much, but I do project that we're going to get back there. Supplies coming down as far as new construction and just units being delivered is going way down. It's going to be less next year. Um, and in certain markets like Dallas, where I'm at, the rent growth, I mean, the population growth is still there. The job growth and the population growth is still there. So you're going to run into demand for more units, which then creates the opportunity to be able to raise the rents.
So all these signs that you're talking about, are these already visible before the closing? And are you changing the business plan from the very get-go, or how that has changed?
Yeah, so that was more of, talking about our existing portfolio as those things started happening. Um, when looking at new deals now, we're definitely being more cautious with our rent bumps and our year over year rent growth. We're being very conservative when it comes to that. We're not doing 3, 4, 5% or whatever, was being done before. And especially in the first year, even the first 2 years, really the first year is just taking it up to market and then maybe a small rent bump the next year, and then maybe kind of scaling it up a little bit, but not being a lot more conservative when we underwrite the deals now on the rent growth.
So let me ask you this, which old assumption is still appearing most frequently in the offering memorandums or sponsor projections? Because you said we're not going to talk about projections, but still you're hoping that the market will change. We're going to come back to maybe the normal, the previous normal. But I think that this is a market reset and this is a new normal. And I hear this very often that this market has a different set of players. So, what is your take on that?
What was the last part? You said that the market has.
It has a different set of players now
Yeah.
because remember the previous market, anybody can get into multifamily, anybody can make money given all the factors about the rents or the on the financing or how it was going. Like market was really good, but this market is so tight and so unpredictable. It just feels like there's a different set of players who are playing in this market. It's not for everybody. What do you think about that?
I mean, I agree, right? There's a lot of syndicators, investors that just aren't doing it anymore, right? The market has kind of um, weeded them out, and I think you've got to be able to operate well. There were syndicators that just really weren't focused on the operation side of things. Really just hired a third party management company and hoped that they knew what they were doing. Um, you can't do that anymore. I mean, you've got to be able to execute on your business plan and have a good system and team to be able to do that. I think you mentioned about the projections. I mean, it's just I already talked about the rent growth. I think that's a big one, but just overall, I always look at the year over year increase on NOI. Like there's only so much you can really push that NOI realistically. And when I see these massive jumps year over year on a pro forma or a syndicator's offering, it's just a lot of the times it's just unrealistic. It's not going to happen.
Okay, so what are the new playbook rules now for multifamily now? How exactly? you are looking at the deals or targeting which deal is the best deal for you to go with. I'm pretty sure the underwriting rules has changed, and we can go through that question later on too. But it's, if we take a holistic approach, we need to understand that like there's a lot more involved than just say, okay, this deal is available here and maybe it's 20% below than it was before. It's a good idea to get into that. I don't think that's the case anymore.
So that when I see that, I see that a lot, right? Oh, 20% discount of what the previous buyer bought it for, or where it was previously priced. I can care less what that is. That to me, that you're putting that line item in there, or you're stating that, uh, that throws a red flag, I guess is what I'm trying to say. I'm not saying run away from it, but who cares? Who cares how much lower it is, and what is it worth right now? The way it's performing, what is it worth now? That's what matters. Not that somebody paid way too much for it and now we're getting it at a 15% or 20% discount. It's not a discount. It's the market determines the value of it. So, the type of deals we're looking for, um, I think, in my opinion, where we're at now, there's a good basis play on a lot of deals. Like the pricing is coming down a lot. What I mean by that is it's probably still not going to be a ton of cash flow. Um, Now we're looking for cash flowing deals and deals that we can increase that cash flow in, but really looking at the price per unit and um, what it's going to cost us to if we wanted to build that property, um, and focusing a little bit more on that, but also looking at the cash flow and what risks there are and um, at least for us, the days of going into really, really hairy deals and getting the bridge loan and doing all that kind of stuff, we uh, put a little more pause on that. Not that, I mean, I think those deals can be great, and we've had some great deals like that, right? So it's kind of hard to say that we won't do those, but um, it's got to be a really good price. So I haven't seen that type of deal at a really, really good price. Um, So stuff we're looking for is something that's maybe we know we can go in and we can operate it better from day one. Maybe it's stabilized or cash flowing a little bit, but we're going to go in there and we're going to use our experience on the operations and really make the value there versus trying to push up all the rents and all that.
So, what is the good price? You said it has to be a good price. So, how would you determine that? What factors you look at it?
Yeah, just you got to look at the risk, right? If the property's not cash flowing, right? That's what we're talking about. A hairy deal that's not cash flowing. You're gonna have to have reserves. You're gonna have to go in with a bridge loan. Um, all those things add layers of risk. So, what that I can't give you an exact percentage or what exactly we're looking for, but the return, I guess, needs to be much higher than what it would be going into a stabilized deal that just needs some improvements. And I haven't seen that. Like what I've seen when I pencil those deals, maybe instead of hitting a 15% IRR or something like that, we're hitting a 16 or 17% IRR. And maybe that's because we're being real conservative on some of the stuff, but it's also, like I said, being realistic as well, not necessarily just conservative, if that makes sense.
Yeah, but you were saying earlier, that a lot of deals are not cash flowing deals, right? So the parameters have been changed, right? Initially, like if we go back a few years back, we look at it, okay, it's cash flowing and I can do this and that, meaning interior, exterior, or wherever the property is, I can take it to the next level. If the rents are below market, I can, increase the rents. But all those things are not happening. We're not seeing any of those things now. So that makes super hard for people to make a judgment whether this is the right deal for me or no. But sometimes, people think, oh my God, oh, this he was selling at 10 million, now he's selling at 8 million. There's a discount, right? 20% right there. Let me get into that deal.
Yeah. Like I said, please ignore that. When somebody tells you that, that means nothing. Absolutely nothing.
Exactly. Exactly. I mean, that those kind of things are happening too in the market at this current point because everybody is doing kind of distress sales. They think, oh, it's distressed. So let's talk about that too. Actually, that's a good question right here. What do
Okay.
you consider distress? Because distress could be different kind of distress, right? Financial, maybe operational, or maybe at the within the team too. There could be some distress that could affect the property. So I would like to hear your viewpoint because you have so much experience and in so many different properties with different, members of the team as well.
Yeah, I mean, I would say a lot of the distress that we're seeing now is just operators that can't make the debt service because their interest rates either went up, the insurance went up, the property taxes went up. They're not able to push the rents and they're not able to cover debt service. Now, when that begins to happen for an operator, the property begins to suffer. So, they begin to scramble and start putting all the funds towards the debt service because they don't want the lender to foreclose, right? So then the property's not getting the deferred maintenance starts piling up. Things aren't getting fixed at the property. Um, Most likely your delinquency starts going up because things aren't getting fixed, right? Your occupancy starts dropping for the same reason. Maybe you have to cut from marketing, so now you're not even getting as much marketing as you were before. So it really starts to um, affect the property hard. And when you're looking at one of these deals, whether the lender has taken it back or if the current owner is trying to sell it before the lender takes it back, you got to really dig in because most likely the delinquency is going to be high, what they're collecting, like I said. There's going to be a ton of deferred maintenance, and you need to take those things into account when you're looking at how much you're going to pay for that property because it's going to take some time and money to clean up your tenant base once you take over, and then obviously the money it's going to cost to then take care of that deferred maintenance that hasn't been taken. And mind you, we're not talking about a couple months. I mean, this could be something that's been going on for years. They could have
Mhm.
continued to kick the can down the road with this lender, and the property's been suffering that entire time. So, definitely something you want to dig into, and that's kind of what I consider distress. There's obviously other different ones, but I feel like that is the major one right now.
So let me ask you this, since we're talking about distress, and then what could be a good buy in the distressed? Because I see in the family offices too, they have started this called distress fund because they're targeting only the distressed properties. So if somebody's targeting the distressed properties, what should be the guidelines for them? The new rules, like what they should look for when they're targeting to get into a distressed property, and how long you think they should also consider how long would it take to stabilize that?
Yeah, I mean, I think it's going to be deal by deal, right? But I think one, they really need to dig into what hasn't been repaired at the property. What needs to be fixed? Are there a bunch of plumbing issues? Are there a bunch of roofs leaking? Are the concrete is a mess in the parking lot? All these typical AC units, water heaters. So you really got to do your homework on that, get some solid numbers, know what you're going to need to just bring the property back up, right? I'm not even talking about upgrades. Like just
Mhm.
get the property where it should be for your residents. Um, and then you got to really dig into your occupancy at the property. You know, is it what is your economic occupancy, not your physical occupancy? Because I'm sure if they're trying to sell, they're gonna, at one point they're gonna stop evicting as hard, right? They're not gonna evict tenants right away, and they're gonna let them stay there not paying, so that the numbers don't look as bad as they really are. But
Mhm.
that buying a property like that is just creates more work for you because now you've got to evict those tenants. You got to the time it takes, the money it takes to get that done. Um, so I think those two things are probably the most important things. If you're doing a loan assumption, I guess there's a process you'll find out. But I mean, a lot of these distressed deals are also the lender has a list of items that they want fixed, and I've seen some properties go into foreclosure for that very reason. Like they want several $100,000 of work to get done at the property, and the owner doesn't have it. Um, so make sure you take that into account. Make sure you take the reserves you're gonna need while you're doing all that. Most likely the property's not going to be cash flowing. So you're going to need a good amount of reserves to make sure you get stabilized. To answer your question as far as like how long, just depends on how bad all that is. Depends probably how long it's been going on, and yeah, how many repairs you're gonna have to do, how much you're gonna have to put towards uh, getting rid of certain tenants and getting new tenants in. So just depends.
Yeah, I think that was the question I was going to ask you. You already answered that part of it. How do you structure a debt to so that it supports the property through renovations or I would say stabilization? Because this is not something that has something positive from day one. And what kind of experience you need? I think you need to be really experienced as well to get into these kind of deals because otherwise it won't work out if you just think like, oh, I'm just starting, it's a good time now. Since there's so many distress assets, I can just get one and run with it. But
Yeah,
there's so many moving parts to it. It's not just buying the property. The real work starts after you get into something.
yeah. I mean, it's a stress for a reason, right? So for you to think that you're just gonna buy it and now it's magically gonna operate well, yeah, I agree with you 100%. You've got to be experienced, got to have a good team, you got to know what you're doing. It's first time buyer of multifamily going into a heavily distressed deal, probably not a good idea.
Mhm. So let's talk about it. If you get into one of these deals, how would you structure the debt to take it to the stabilization level?
Yeah, I mean that's a good question. So assuming that it's in enough stress where you can't get, I mean, the first thing we're trying to do is can we get agency and CMBS or some type of fixed rate loan. That's not the case, then you got to go to either a bridge loan or you could try a local bank. They might have some appetite for it. Um, I would either one of those. I would make sure that you give yourself enough time as far as the maturity of the loan. Don't go into a 1 year loan or even maybe a 2 year minimum 2 year, and I would
I would
probably
even go 3 years, 3 to 5 years, 2 years not
yeah,
gonna be enough.
I would prefer a 3 year just in case, and an actual 3 year, not an extension that you have to hit certain numbers and all this kind of stuff. Um, that would be ideal. A bridge loan that has a true 3 years on it, that gives you more than enough time. You shouldn't need that much time if you're a good operator, but just to be safe,
Mhm.
you get yourself a rate cap just to be safe as well, right? Um, So for whatever reason, I mean, look, they're talking about raising the rates the next meeting. So you never know, right? Those are things we can't control. So, pretty much, I don't want to say de-risk because the deal is going to have risk, but at least making that risk less by, not over leveraging it as well with debt. Um, so yeah, maybe don't get the 80% bridge loan and maybe do something in the 65 or I mean even 70 might be a little high.
But operationally, how would it go, right? If a distressed asset is not making any money, and then even if you get that 3-year loan, even if it's a fixed loan. So since you are heavy in operations, and then I know you had your property management company before, I'm not sure if you still have that.
We do.
And then you do have the construction company where you do the renovations and all that too. So you're pretty heavy on the operation side, right? So how would you operate but staying lean? That's the key thing over here. Staying lean is very, very important at this time. So how would you operate so that you are able to sustain?
Right. So I mean the property is going to need improvements, right? If it's not cash flowing, it's because it needs some type of improvement. So you also need to be careful not to you can't just sustain the way it is, right? So you are going to have to spend some money is what I'm getting at.
Mhm.
But that doesn't mean that you have to waste money. And really, I think a lot of that comes down to being involved. Okay, if you just hire a third party property management company and don't really dig into it and just put them there, they're going to have a lot of wasteful expenses, things that
Mhm.
they think are maybe necessary. They do it on all their other properties, right? So we're gonna put in this software, we're gonna do this, we're gonna do that, we're gonna do that, and no, like there's a lot of things you don't need to do. You need to scale down those expenses and really just pay for what's necessary. You don't need, and I'll give you just a quick example. Like you don't need a software to answer your Google reviews. You don't need to be paying $100 and something a month for like no. And I know that's a small one, but just those things add up. When you've got a bunch of those, it really begins to add up. A lot of the third party management companies charge fees that don't even go to anything. It literally just goes to the management company. So you've got to dig into things like that if you're not going to be doing your own management, right? Which I'm not saying I suggest right off the bat for you to do that either, because that's a whole other beast as well. Um, so yeah, you just have to be involved. You have to be really involved and know what you're paying for every month to be able to run it tight.
Okay, so let me ask you this. You said you don't want to start managing the property yourself because maybe you're just getting in or you're new, and you need to hire the property management company. So what is the difference between the two? First of all, let's understand that from you since you have the experience with the third party as well as you ran your own property management company. So give us the difference between the two. What are the pros and cons so that we can understand how to better operate the properties
Yeah. So the difference between when we were using third party management versus
versus managing
now we're
yourself.
using our own management company. Um, a lot of it has to do with what I just talked about. I mean, our expenses are the bare minimum. There is no fluff in our financials. It is, we're paying for what's just necessary. Um, when it comes to any contracts and anything we're paying for, we're heavily negotiating everything. We're getting the best price we can possibly get. Um, for our vendors, same thing. We're getting the best price we can. Really, not using a ton of vendors. Like we really try to use our staff when it comes to especially the maintenance and even we do our pay-per-click campaigns is all done in-house, so we're not paying some third-party marketing company to do that. A lot of the make readies and maybe even some of the upgrades are done in-house, so we're not having to pay vendors. Um, a lot of the HVAC work, a lot of like pool cleaning companies, like all that kind of stuff. We try to do as much as we can in-house. Um, so yeah, I think that's really the big difference. We're watching it and we really care about the expenses.
That's getting now the expenses. And then your other term that you use in negotiating, you say you're negotiating with the vendors. So what kind of skills do you need to negotiate with these vendors? Because right off the top, if somebody's new, they won't know exactly, which is like won't even make sense for the people who are new.
Yeah, something like that. If you're really not experienced and know what's a good price, I would say get several different estimates, right? Get several estimates and then get a feel for the vendor as well. It's not just the lowest isn't always the best, right?
Mhm.
You gotta see if you can get some references, speak to the actual references, um, and then let's say you have at least two that you feel confident about as far as you've spoken to the references, you've checked whatever you can, they've got the credentials they should have. And I'm being general because it depends what you're doing, whether it's a plumber, landscaper, whatever you're trying to negotiate. And then you go back to them and you just negotiate, right? Like if they sent you a quote for 3,500, say, hey, I mean, I'm going to give you this property and we've got several other properties coming online and, can you do it for 3,000 or something like that?
Hmm. So let me ask you this, since you're in construction, and you were dealing with a lot of properties, what physical problems are most underestimated when we are checking these properties or just doing our basic, physical due diligence?
Yeah, that's a good question. I would say HVAC and plumbing is probably up there, especially if we're talking about an older property. Um, when those start shutting down, it can get pretty pricey. And if you've got some major plumbing issues, that's going to be pretty pricey right off the bat. So I would suggest on the front end getting those two inspected really well. Roof can always be a big one, right? You want to make sure you get the roofs inspected on the front end, know what you're dealing with there. Let me think what else. Drainage. So if you have bad drainage, which most properties do, what that means is either you don't have any gutters or downspouts, and even if you do have them, your downspouts are just shooting out right onto the property. Your water always wants to go away from your property. If your water if the water goes towards your foundation of your buildings, it's going to cause issues. Especially in Texas, where the soil here just shifts all the time. That's the worst thing you can have. Your foundation is going to start shifting, which then can also create issues with your plumbing. Or you can have just water intrusion going in too, depending on how bad it is. So that's something to check as well. Making sure your upgrades, you know where you're talking about with your upgrades and your numbers make sense. Like don't think you can upgrade a unit for 5K, right? Like that's not going to happen. Um, after COVID, I mean the prices have gone up and they've stayed up there. They've come down a little bit on some items, but I mean upgrading a unit, it's to get it done under 10K is pretty tough.
Yeah, but I think you need a budget for that too. So the follow-up question will be, how do you turn these property inspections or these all the work that needs to be done or the bids that you're getting from the contractors? How do you turn that into realistic CapEx budget for you? I mean, what has worked for you in the past, or how differently that you're doing that now, setting that CapEx budget aside so you can manage that properly.
Yeah, I mean, we before we ever close on a property, we've got hard numbers. Like we know exactly what we're gonna do. We know exactly what it's gonna cost. Now the do part is what's kind of shifted. You know, how many things are we going to do with the property? How much upgrades? You know, if we're upgrading a unit, are we going to rip out all the cabinets and do new countertops and you know go the whole 9 yards, or are we going to just do some cabinet fronts and some new flooring or something like that, right? So um, really depends on the market, really depends on what your business plan is, what you're seeing with your comps and what they're getting and what that looks like. But we're not just going in and fully upgrading a unit, right? Like that's never without doing all that homework beforehand. I mean, that's not going to be our business plan. You know, there's certain things at the property that we may skip out on doing. I'm trying not to talk in general, but it's just, you know, between a class C and a class A and just a lot of different things that it depends. We want to keep our, so I mentioned early on the basis play, right? Like a low basis. So if you buy something at a low basis, but you put a ton of money into it, you're now defeating the purpose, right? Like you want to buy something at a low basis and just put what's necessary to keep it at a good basis, so then you can go and flip it eventually.
Hmm. That's true, yeah, because it depends upon the multiple other factors too, right? Where the property is, the location, and what kind of appetite people have over there from the renting perspective.
Yeah, I mean, I think it's very location driven when it comes to that, but um, you know, and how low your current rents are. Um, but it's more about the location, the micro location, like who your residents are going to be, what's really important to them. You know, I know certain like classy areas and some of the residents that live there like don't really care about the full upgrade of the unit. Like what they really care, they want to make sure everything's working properly. They want to make sure that the property's safe and secure, and they can have their family there, and you know maybe some nicer appliances, but not necessarily all the other stuff. So I
Mhm.
mean, it just really depends on the market and the demographic you're going after.
So, what is your take on the market overall? Are you still looking to buy, or are you sitting on the sideline and your investor base? Are they supporting you, or what's happening?
Yeah, so we're still active. We're still looking to buy. I don't think there's ever really a wrong time to buy if you're buying correctly for the market you're in. Um,
Mhm.
you know, I've been in a similar market back in '09, you know, after '08, right? For several years. Wasn't the same that's happened now, but it was a down cycle, right? We kept buying back then. Everything we bought did well because we were getting it at ridiculous prices. Um, so yes, we just look if the property's cash flowing, let's say I close on a property today and it's cash flowing and I've got a fixed rate loan on it, um, and all I'm going to do is make it better from this point on, I can care less about all those other things, right? At least for the immediate, like when I bought that property, I'm thinking I'm going to own this for at least 5 years. So what's happening right now doesn't really affect me that much. Now, if we go into a major recession, maybe, right? That's a different case. But um, yeah, so that's the way I look at it. Like if you can buy something now at a great price and it can be cash flowing, and you've got it your capital stacked to where you can at least hold it for 5 years, um, I believe you would be in a good situation.
Yeah, but I think 2008 crash and the market that we are in, I'm not sure is 100% exactly the same phenomena. But I think there are some similarity, but not exactly the same now what's happening. Right now, it kind of feels like everything is totally like haywire.
No, the fundamentals are 1,000% different. I mean, yeah,
Exactly.
I agree, but I mean, there was actually more. The values dropped
Hmm.
even greater, I think, back then. At least it felt like it because they were really well, I guess they were inflated now too. But um, I do think the multifamily's gotten affected a lot more this go round versus the last time. So yeah, I think it's different, but I think we're in the same position in the cycle of how. So for several years after that, I mean, you know, '09, 2010, 2011. It wasn't really till like maybe 2012 that things were maybe starting to look a little brighter. So I mean, there was several years after that where it was just capital was tight, everything was tight. So um, I feel like we're kind of in the same place. Maybe we didn't get there the same way, but um, yeah,
Yeah, I think 2008 was more like a residential kind of thing, right? And then crisis is more like we see more like the commercial owners are more being hurt this time in this market because like going in bases are higher or the loan that they got, the bridge loan that they got 3 years and coming up now, so they do not have enough reserves or deeper pockets to survive. I think that's the biggest difference I am seeing
agreed,
now.
agreed. And I think it's said this the other day, but like COVID really did something there because before COVID happened, there were signs that we were starting to go down into a down cycle slowly, but it was starting to happen, and it was kind of time for that to happen, and then COVID happened right there. Prices went nuts, right, in 20 end of 2020 and then 2021, and so that definitely made things different. I guess is what I'm getting at, and it really shook things up. Where yeah, I agree. I mean, this is for multifamily, it's definitely worse this go around than last. I do think there is some starting to affect single family a little bit more now as well.
Mhm.
Not as much as back in '08 and all that, but I think they're starting to see the effects as well.
Hmm. Yeah, that's true. And I think we've been talking about all the negative stuff, but market might be good for some people if you have the money or deeper pockets. Like I say, this market is for a different set of players because who know how to ride this market, they're gonna be the winners. So it's not for everybody. Not everybody has the same appetite to get into a distressed asset and then hold it for 3, 4, 5 years with zero returns, and on top of that, spending money to renovate it to bring it to the market's going to shift. Nothing stays the same because change is the name of the game. That's always there. But the thing is, at this time you got to be a little bit more cautious or more careful what kind of assets somebody can get into, right? And then the next question I was thinking about that, since in this market too you're still thriving, you're raising tons of capital, seems like you're getting into new deals. I do see all the time your updates. So how can an operator scale a portfolio without losing visibility, into what is happening around them in this market? Because everybody's kind of, caught up in this thing that, oh, market is bad, let me hold on, let me stay on the sidelines. It's not the rock bottom yet. I mean, these are the, I hear all the time questions and even answers. People are saying, is it the rock bottom yet? Should I wait a little bit longer? That's what I hear from our investor base as well. So that's the overall sentiment that I'm trying to share with you and trying to understand if you're seeing the same thing or something different or how you're still scaling. Because a lot of people, they think it's a good market for them. They can scale because there is a room to scale. But what kind of mindset or what kind of hat you should wear to understand that, how to do it?
Yeah, so I mean, look, everything gets harder when you're in a down cycle like this. Like I mentioned, like the capital gets harder from a loan perspective, things get harder. From an equity perspective, things get harder. So it's not easy. It's not easy to scale and buy a lot of deals. Um, we haven't necessarily been on the sideline, but it's been tough getting deals to make sense as far as getting them to pencil, and then on top of that, getting everything lined up. So to me, that tells me that it's probably a good time. And I know that it maybe doesn't sound like that, but look, when things were really easy, that's everybody that's getting burned now. Everybody that bought deals in 2020, 2021, maybe even I think early 2022, money was real easy. Lenders were giving you 80, 85%. Um, Equity was everywhere. That doesn't mean it was a good time to buy. Um, so it's a cycle. It happens all the time. Every time the market's going up, the money gets easier, and then we hit that plateau, and then it starts coming down, and then everything gets harder. Um,
Mhm.
Fundamentals for multifamily are still very strong. So that's why we're still in it, why we're still um, looking at deals, trying to acquire more deals. You still The pricing for single family has not come down dramatically. It's still very hard to afford your first home, which is pushing a lot of
It's
people
the
to go
key.
rent.
Hmm.
In certain markets, you're having still great job growth and population growth. Um, so those fundamentals are still there. It's just how do you structure and buy these deals now, and how do you make sure that you're buying them at a good basis and that you're not paying attention to, hey, it's a 20% discount from where it was a few years back. Um, don't pay any attention to that. Like I said, just make sure it's a good basis that makes sense. And then yeah, it's going to be harder to raise equity. It's going to be harder to get a good loan on it. Um, and it is what it is. Like if you can put it together, you're most likely going to be thanking yourself later on.
Hmm. That's good. And another question comes to my mind is like a lot of people they are getting these defaults or the foreclosures. So what are the owners doing in that scenario, to protect themselves or protect the value of their properties?
Yeah, I mean, it's happening all over, right? You're seeing a lot of different things, right? Where obviously capital calls, so they're going back to their investors and seeing if they can raise more equity from their investors and build up that reserve or whatever it is they need. Um, I think the important piece is having that plan, like okay, what are you going to use the funds for, and how is this going to move forward, right? Like how is it and that's where it gets a little tricky on some of these where they really don't have an answer for that. And the
That's true. But George, the thing is over here, that's what people have to understand that. And I have this conversation with my investors all the time too, because when you ask, okay, there's a capital call, not that I had one, but if they have, people think like, oh my God, I don't think I'm going to put more money into a sunken ship because the ship is going down. Why should I put more money? That's the kind of general sentiment over there. But the question is, if the property is going into distress, right? Somebody else is gonna come, bring the new equity, buy it, and start from ground zero. So if the current operator has a good plan thinking that I just got this distress, I'm starting ground zero again, how would think they should do things differently, considering I said maybe it's a new distress asset, somehow have to pump in more money into it and bring it back up. But I don't see that happening a lot in the market because people just feel like we ran out of options basically with the lenders. So we'll just say, okay, this is it, basically. But go ahead.
Yeah, no, I mean, you kind of said what I was gonna say. A lot of it's gonna depend on that senior lender, and um, if there's not a way to recapitalize them with the money you need, then you need them to be on board for however long it's gonna take, right? Whatever that business plan is. But like you also mentioned, it's some of these have the distress started last year or even the year before that, and at some point the lender just can only do so much, and they just got to take it back. And are they gonna make back the money that they've got into the deal? Who knows? And but I think at some point, even for their investors, they need to do something. They can't just keep waiting and waiting. I'm not on their side, don't get me wrong, but I just, you know,
Yeah.
that's the thinking, and then I think that's what we see happening this year, and why there's been several this year, and um, it's just the lenders have got to make some moves on their side.
Mm. So I know a lot of recaps are happening too, like we were talking earlier, before the recording. So I do have a question for that too. What make you decide actually, what kind of funding or stabilization plan or protections, that you feel like, okay, this is the right candidate for the recap, or, that I should have these, like, pieces into the place for the new capital requirement.
Yeah, so not replacing, I guess, but adding new capital to an existing deal, right? Is that what we're
Right.
not a true recap, because you're not talking about replacing it, right?
In some instance, I have noticed that people are doing that too. They're just,
Like actually giving the capital back to
actually,
the investor.
exact. No, not giving the zeroing
Okay,
out and
so
bringing in the new equity
yeah,
in there.
yeah. So that's not. I guess it's like a hybrid recap. Usually a recap, what it used to mean was you pay out the investors and then bring in new capital, but that's more of when a deal's doing well and you want to recap it or something like that. But yeah, in this situation, it's tough. I guess the operators are trying to not lose the investors' capital, right? And they're thinking that maybe if we bring in this new equity and it won't completely wipe out the existing investors, maybe they could at least get something at the end of the day. Um, so I believe that's the thinking behind it, right? But it's like I mentioned, like it's got to be something where there's got to be a business plan there that can be executed on so that that works out. If not, then you're just bringing new money to a deal that's still not going to work out.
Mm. That's good. Let me ask the audience. Do you guys have any questions? I know we've been chatting for a long time. If you have any questions, please use the Q&A or chat so that we can take that question and address that as well. Okay, I just feel like, no matter how many questions we go through, still we feel like there is something is missing, something is unknown, right? It's like, don't you feel that, or it's just me? I just feel like, oh, I do not know enough. I need to know more. But more what, right? Because the standards are still the basics or the fundamentals are still the same, how to underwrite the property or how to look at the things, but I just feel like there gotta be some different angle that we need to look at it, that I might be missing, you know
Yeah, I think, for me, one thing is one thing that's not very clear is the cap rate right now, right? And just because there's not enough deals actually getting closed, and um, it's kind of hard to say where they're at in any given market, any type of um, property class. So I think that's tough. And then kind of that exit cap, right? Deciding on what that exit cap's going to be, which has always been a guess in a sense, but maybe an educated guess. But um, yeah, there's still a lot of unknowns. I think you mentioned the war earlier. Before the war, I felt like things were getting a little clearer. Rates were even starting to come down a little. And then we had the war, and that's obviously changed some things. And even when we thought it was coming to an end, felt like there was more
Yeah.
clarity again. So I think the war has definitely thrown a wrench in there. Um, Even with investors as well, some of them kind of wanting to sit on the sidelines, like you mentioned, because of it. So it's always going to be something, right? I mean, when the war's over, then we're going to have the elections, and then um, there's always going to be these variables that we can't control. Um, so yeah, we just got to figure out how to keep moving.
Okay, so I'm looking in the Q&A. There's like, I'm not sure if it's a question or a comment. Clarence McCrae, he said, spending for CapEx isn't motivated by depreciation schedules. I also understand that it depends upon what market dictates.
Yeah, definitely depends on the market. I think on some of the so there's some deferred maintenance that you definitely want to take care of on your CapEx. So, I'm more on the upgrade side, I think is where that's where we've had to make some different decisions on what type of upgrades we do and we don't. On some of the deferred maintenance, I mean, look, we still want to go in, fix the roofs, make sure that we don't have any leaking roofs. If we got to replace them, we're replacing them. Same with the HVAC, same with the water heater, any safety stuff, if there's any tripping hazards, any things like that. Like we want to definitely harden the property still. Um, it's more of what kind of upgrades we want to do.
Interesting. So Vince joined earlier, I guess he dropped. He says, that hairline is fire. Good to see you guys.
Nice.
Uh, okay, so I think somebody just popped in a question. Harold wants to know, do you have business in Los Angeles?
We have not done anything in California yet. Yeah, just I don't know. Just depends.
But you should though. I'm in California. I'll help you.
And I don't think I would buy real estate in California.
Mm,
Now, property management and construction, maybe more property management than construction because I feel like that would be a nightmare too. But
mm.
yeah. So if we had enough
Construction.
units to manage, we would maybe do property management there.
So I'm going to ask you one golden question, George. So I'm going to give you a scenario. So here's my golden question. Imagine that a family office gives you patience capital with one condition. Over the next 24 months, you may make only one multifamily investment, and protecting the downside is more important than producing the highest projected return. What would have to be true about the basis, market, property, debt, reserves, operating team, and business plan before you would commit that capital? So it's a whole loaded question, like it's kind of the whole synopsis of the market and the multifamily investing, everything.
Yeah. Let me try to answer all that. Start with the market. So it would have to be a strong market, one that's shown population growth and job growth, and that continues to show signs of it um, continuing on. For instance, like the numbers at in Dallas are very strong when it comes to job growth and population growth. Um, Another market we like is Northwest Arkansas has also got very strong numbers when it comes to that. Um, so that's one, right, as far as the market. And I'm beyond that, micro market as well, but I won't get too much into that. Then property. I would say a property that's ideally, if I can only choose one property, right? That's what we said. An A-class deal that um, I can come in with a fixed rate loan, but that I feel like the rents are under market, possibly just finished a lease up, or and they've had to give a lot of concessions, and they just dropped the rents to just get it occupied. Um, and I know I can go in there and I can push those rents up some to the market. I can possibly operate it better than they were. Um, but since it's stabilized in a sense, I could still go in with a nice fixed rate loan. Um, that would be ideal. So where it's cash flowing from day one, and then it's just continuing to increase the cash flow, right, as we bump up those rents and add those efficiencies on the operations. So did I miss anything?
And what single red flag would stop you to keep the capital uninvested, regardless of how compelling the projected return appeared?
The projected return. So I would say what the going in looks like on the property. I don't want to say I don't care about the projected. There's just so many variables that go into a projected return. Um, so I mean, anybody can put some numbers together on a spreadsheet and show a great projected return. I'm more curious on what it's producing day one. Is the am I going to have less risk because the property's cash flowing day one versus a lot of things need to happen to hit those certain projections, and there could be some risk in that. Um, so I would focus a little bit more on that, and then begin to focus on the value add. And I say because that projected return is going to depend on the value being added. I mentioned the year over year, so I would take a strong look at the year over year NOI or gross income and kind of see how much they're projecting every year. And if there's this massive jump one year to the next, like really question that and dig in on how they're going to possibly do that.
Mm. Good. So let me ask the audience, do you guys have any question? If you have any question, please put your question in the Q&A or chat. So Harold says, how many units do you need? I agree, Los Angeles is a rough market, but not impossible. I agree, Harold. All markets are good as long as we do our due diligence, and especially in the, I say, micro markets, right? Going into the sub markets and kind of understand the dynamics there before getting into any deal. So I do not see any more questions, George. So one last question before we close. If everyone remembers only one rule from today, the rule most likely to protect them from a costly mistake, what should that rule be?
I'm sorry. I was reading Harold's question about the units in Los Angeles.
So
I'll,
we're
I'll
talking
answer
about
that.
that. Yeah. So we were, okay, go ahead, answer that first,
Yeah, yeah.
Harold.
So I mean, we would need roughly like 500 to 600 units or so to go into
There
a
you
new
go,
market.
Harold. If he wants to, yeah. So he'll go into Los Angeles too. If you have that kind of deals, please share with George. So George, I'm going to repeat my question again. I was
Yes,
asking you
yes,
the
please.
last
Go ahead.
question. So if everyone remembers only one new rule from today, the rule most likely to protect them from a costly mistake, what should be that rule?
Ah, just one rule. Look at look at how the property's performing right now. What it's collecting right now, really collecting, not physical occupancy. What the property is actually collecting and what it's going to look like in the first 30 days that you own it. And that'll tell you a lot. You know, if you're going to need a bunch of reserves, if you're going to, forget about the projections and all the things that you're going to add to it. What are you starting with? I guess.
The going in basis points. I think that determines everything.
Yeah, and even the going in cap rate, like you got to be careful with that too, because there's things that are going to
Mhm.
go up um, on some of your expenses, or if their expenses are unrealistic. So more of an adjusted going in cap, adjusted for the higher taxes. You know, you're going to get higher taxes. Maybe the insurance they're paying is really low, and you're not going to be able to get it as low. So that'll give you an idea of what your first few months are going to look like at that property. Um, and that should help you.
That's true. And by the end of the day, everybody has to understand that it's only one bucket where you're putting out or putting in. So that balance has to be there all the time, regardless. And if that one is balanced, and you can strive in every market, correct?
Yep.
I
Yep.
think that's the bottom line here. Thank you, George. So before we close out, I don't see any more questions. So if you can share with us how people can reach out to you or connect with you, if they wanted to learn more about your work or what you're doing.
Absolutely. I put some stuff in the chat, but if they can just email me at any time. So it's Jorge. I do go by George, but it's spelled Jorge, Jorge at elevatecig.com.
Thank you. And I think there's another follow-up question from Harold. He wants to know if you are members, what organization are you both members of?
Um, gosh, we're I'm part of all the, not all of them, but a lot of the apartment associations, Dallas, Houston, South Dakota, a few others. Um, Part of some mentoring groups as well. I guess RE Mentor and a few others. I don't know, Vinky, if you have any, but
Yeah, likewise, the same way, kind of vibrating in the same wavelength everywhere, almost in the real estate. Yeah. I don't see any more questions, George. So thank you so much. I should say, Jorge, thank you so much for sharing your experience and taking us beyond market headlines and how multifamily is doing and what are the changes in the rules. It's just like you're more scrutinizing things or very strictly looking at the things. It's not the same lens that you used before, a few years back. So then your set of glasses has changed. So I think number has gone even bigger because you have to see much closer. Like my husband says, use the magnifying glass. So that's the new rule,
wow.
actually, use the magnifying glass. So thanks again, George. Any last words that you wanted to share with our audience?
Um, no, just look, I know we talked a lot about the down cycle and all those things, but I do want to say I still feel very well about multifamily and bullish on the long-term multifamily investing. Um, you just have to look at things closer, like Vinky said. We're just in a different market, so you got to take that into account.
Thank you so much again, George. Really appreciate you. And thanks everyone for joining us today. Until next time, stay inspired, stay intentional, and keep building your wealth vibe. We'll see you next time with another awesome guest.